all. Hello and welcome. You're watching News 9. This is Business Plus. My name is Shweta Kothari. We're bringing you stories from the world of business, policy and economy. First up, let's understand how markets performed this afternoon. My colleague Suyash here with me in the studio. Suyash, a volatile session on Dalal Street today.
Definitely, Shweta. It was a volatile session for the D Street, and it was a second consecutive session where we saw that markets opened deep in the red, but they made a smart recovery and ended in the green. Right? Okay. Today was another, like after Monday's session. Today we also saw that similar kind of movement. Now Sensex was up at close at about 0.21% at 65,539 mark. Nifty on the other hand gained about 0.16%, but still close below the crucial resistance level of 19,500. Although we have seen time and again the index has been taking support at 19,300. So that was good news for the bulls, that the index once again managed to defend that 19,300. Now mid cap on the other hand, the Nifty mid cap 100 index closed on a flattish note. It was up about 0.08% at 37,801 mark, whereas small cap index outperformed both Sensex and Nifty, and it was up 0.57% at 11,728 levels.
All right. Vijay Bambani, who's an author and CEO of bsplindia.com, also joining us live on the show at this point in time. Vijay, appreciate you taking time out this afternoon. Thanks for speaking to News 9. I want to begin by asking, what are you making of this very volatile Wednesday on Dalal Street today?
Thank you for having me on your show, and hello to all our viewers. It's a pleasure and privilege to be on your channel. What I am making out of what I'm seeing in the market is banking is relatively speaking underperforming the broader market, and that too for a very valid reason. What we are witnessing is concerns worldwide, not just India specific, of spiking inflation, and the worst kind of inflation is food inflation, because demand is non-elastic. We can't do without food, and when you spend a lot of money on food, there's very little money left for investing in stocks. So our savings rate tends to go down. So this is one reason why inflation is really biting. And whenever inflation rises, it is the banking stocks that take a hit on the chin, because they are very sensitive to inflation for the simple reason that, like I said, when you spend more money, an average Indian household spends more money on food, they are going to place smaller deposits in the bank as fixed deposits. So bank collections also tend to go down. So there is a very valid reason why you're seeing banking underperform the broader markets.
All right, let's quickly pull up those graphics, Suyash, where you can explain to us how did various indices and sectors perform this afternoon.
Yes, Shweta. So as Mr. Vijay was saying, the banking sector was under pressure. One of the triggers is obviously inflation print coming much higher than what the market has expected. Another reason why the banking stocks were under pressure was Fitch earlier today, actually yesterday, said that it will downgrade as many as 10 US banks, including JP Morgan. Now, if you remember, this was on the back of Moody's downgrading about 10 regional US banks, and Fitch also downgrading the credit rating of the US credit. Right now, these have been a major overhang for the banks, and we saw that today there was a sell-off in the banking sector, which was down about Nifty Bank was down about 0.33%. Realty was up about 1.1%. IT and auto and FMCG sectors did provide and help the market make that smart comeback. It was Nifty IT initially where we saw Infosys having that 1.6 billion deal, which has eased concerns that the deal pipeline has or the discretionary spending of the clients has decreased. So the order book coming from the IT and even HCL Technologies bagged a $2 billion contract last week. So the concerns regarding that weak order book has at least taken a backseat for now. Auto was another sector. It was up about 0.64%. FMCG was a surprise despite the inflation print coming at about 7.44%. And what was more damning for the FMCG sector was a sharp spike in the food inflation, which rose about 11.5% on a year-on-year basis.
All right, for FMCG particularly, let's quickly go back to Vijay and explain, ask him to explain in fact what's happening here. Interesting, food inflation at an all-time high, retail inflation at 7.44%, yet FMCG pack seems to be ducking the trend and closing in the green this afternoon.
Well, like I said, food and FMCG products, these are not negotiable. So, is an average Indian consumer going to cut out soap for bathing on a day-to-day basis? I don't think so. This is what you call non-discretionary spending. So, food, shelter, clothing, water, medicines, etc. These are non-negotiable demand products, and they should continue to do well. They will be defensive sectors, as it is said. These will provide you a cave to hide or park your money when other higher risk and interest rate sensitive stocks like banks, NBFCs, and any sector which depends heavily on EMI based sales or sector which is very capital intensive and is nursing a lot of debt on which it has to pay interest. So FMCG will be a good place to hide, and it has been a market outperformer. In my humble opinion, it will continue to remain a market outperformer.
Sir, the consumption stocks in general, like if we saw the Q1 earnings of them, they posted a robust improvement in profitability now, but the rise in profitability was mainly because of the declining input costs, as crude was on a decline. But now that inflation is once again surging, the crude oil prices are once again surging, it will hit the profitability of consumption companies because we didn't see any growth in volumes. So can we expect some correction going forward?
Yes, corrections in any sector which is a relative outperformer. Right? What is relative outperformer? In a rising market, it rises more in percentage terms as compared to the broader market, and in a falling market, it falls less, or it is steady, or maybe even not fall. But it will fall less. And as far as your concerns about crude are concerned, I have a kind of a contrarian opinion. There is no rally, in my opinion. Forget about the super cycle. There is no rally. There is no bull market in crude. This is unbacked currency which has been printed post-COVID, which is triggering an inflation. And do you see buyers banging on the doors of crude exporters, or are you seeing exporters creating a man-made shortage by cutting output? So when you see the Saudis cutting more than 1 million barrels a day, the Russians following up with approximately 800 barrels a day in output cut, you basically see that prices are rising because artificial scarcity is being created. As a matter of fact, look at what happened to natural gas. Natural gas spiked up last week on Wednesday rather, when news came that three companies in Australia which supply LNG, liquefied natural gas, are on the verge of a very crippling labor strike. Now, these companies supply 10% of natural gas to the world. When this news came on Wednesday, natural gas shot up. We sent out a report saying this is nothing but fear mongering. Yes, there would be strikes, but do remember, Australian companies do not supply natural gas to Europe where the price has jumped. They only supply to Asia, and spot delivery prices in Asia have not jumped. Very promptly on Thursday, you've seen a collapse in prices. Even today, you're seeing a 6% decline in natural gas on my trading terminal. So I don't think your concerns about rising crude or natural gas prices going forward will hit margins of FMCG or consumption companies. As a matter of fact, I have a very bearish view for crude and natural gas going forward in the year 2024, particularly after the vernal equinox sets in on 19th March. I'm not talking of astrology, I'm talking of change in season. That is when the warm weather kicks in and heating demand for these fuels falls.
Okay, since we're talking about crude, I wanted to ask you, Vijay, at this juncture, how do you see the crude journey from here on? You know, you pointed out that there's been an artificial shortage created. OPEC has cut down its production twice now. Do you see crude prices going up? What is the trajectory of crude that you are foreseeing at this point?
Let us first understand that crude is not just a commodity. It is a very complex market. To that extent, even natural gas. There is geopolitics, there is demand-supply equation, there is politics, there is terrorism, and there is demand-supply push, and therefore this is a very complex market. Vis-a-vis, what you see is what you get does not exist in energy markets at all. You see, OPEC as a cartel, as an organization of exporting countries, sets quotas for all its members as to how much they can produce and export. And these quotas are actually violated more often than they are adhered to. So, what is being said and what is being done are two different things. They are like chalk and cheese. So, will crude prices go up? I would go to the extent of saying yes, the Saudis and the Russians, along with OPEC plus, OPEC and non-OPEC members who come together, will attempt to push prices of crude higher. But will crude prices sustain higher? In my humble opinion, no. They will go up only to meet resistance. Do remember, anything above 80 to $85 a barrel in WTI crude terms, Western Texas Intermediate Grade crude terms, will suddenly see demand destruction to the detriment of fossil fuels and to the benefit of shale oil and shale gas. So if the OPEC, and they're very aware, they're very clued on, they're very smart people, they know that if they take crude oil prices beyond 90, they are axing their own feet. So I don't think it will happen.
Sir, but US crude stock has also dropped by about 6.2 million barrels last week. Now, this was much ahead of the expectations, which had pegged it at about a 2.3 million drop. So clearly, we are seeing that the supply, that the stockpile of crude is also declining, significantly and much beyond the expectation of the market. So, is it not going to give that a trigger for the crude prices to increase further, at least in the very short term?
You see, prices move based on developments, news events, and guidance or announcements by the administration. Now, drawdown of reserves is not something new. The US has gone on this path deliberately, well known in the public domain since 2022. The US has tried to get OPEC to raise its output and has failed, and therefore drawn upon its strategic and non-strategic petroleum reserves, which is unknown. And any event that is known to the market does not cause a shock. It is the unknown unknown, as it is known in behavioral finance. Unknown unknown is something you never imagined, you did not know, but it occurs. Now, the fall in inventory is not an unknown unknown, which is why on my screen I'm seeing more than 150 rupees decline in crude on the MCX as I'm talking to you during this interview. Market is very comfortable with the fact that these drawdowns will occur. There is an election in the US in November 2024. Ahead of the election, every time this election occurs, the administration dips into its kitty of crude, supplies it at the petrol pump so they can ease the inflation and fuel price for an average citizen. So this is a once in a 4-year phenomena. Market knows about it, so there's no panic.
So talking about unknowns is like China's economic activity. One week we read that activity is picking up, and then the other week the macroeconomic data shows that the economic activity is actually declining. So China being a very big importer of crude, how do you see that dynamic playing out in the prices?
Well, do you actually know that China has struck crude oil and natural gas both, and has huge reserves of methane hydrates, which is 164 times bigger than natural gas reserves per square meter. China is also building up its own reserves, which are supposed to be, of course, significantly larger than the US. And China has been stockpiling crude. And secondly, the economic data that you are so talking about China is something I would take with not just a fistful of salt, but with a gunny sack full of salt. Data from China tends to be colored and checkered at best. Look at the Bloomberg or the Reuters reports on the tele-rate tickers today. The Chinese government is actually telling funds not to sell shares on the Chinese stock exchanges because the stock market is going down. The Chinese have stopped disclosing data of unemployment in the youth. The Chinese have stopped giving NPAs or non-performing assets bank-wise, individual bank-wise since the last couple of years. They refuse to divulge the shadow inventory of commodities that are lying in their godowns unsold. So, are you looking at a very robust economy from my point of view as a trader? No, I don't think so. I don't think China is going to be a major domo consumer of commodities. It's already coming down where its exports are concerned. Look at the price of iron ore, which has collapsed in China. Look at the price of copper, which is the bellwether and barometer of industrial activity in the world. Copper prices are sharply lower, and these are all telling me that we are down for slower times where China is concerned.
All right, and sticking on to crude, I think the conversation would remain incomplete if we are not to bring in Russia into the conversation. Now, crude oil import from Russia rose nearly threefold in the first quarter of this fiscal year compared to the last quarter or the first quarter of last fiscal year. How are you looking the relationship between India and Russia going forward, mainly on the back of the fact that the interest rates in Russia today are at an all-time high? How is that going to impact crude and, of course, the prices of crude oil that will be delivered to India?
First of all, it needs to be understood that whether it is the Middle Eastern countries or it is Russia, when they are depending on exports of fossil fuels to raise revenues, there is only so much bluffing that you can do by triggering output cuts and raising prices. When you resort to output cuts, the inventory that you have in your oil wells, the valuation of that inventory goes up, sure. But how do you raise cash? You will raise cash not on your inventory valuations, but by selling. And when you start to sell, the price comes down. So in commodity traders, us commodity traders, we have an old saying, the cure for high commodity prices is high commodity prices. So when prices are going up, Russia has no other recourse but to sell more crude and raise cash. Remember, they are at war with Ukraine and they need to fund this war. And we all know from secondary school economics that we were taught since childhood that wars are very expensive affairs. They are inflationary. They trigger a lot of economic distress and pressures on the economy. And therefore, no matter how much the Russians bluff, or for that matter, the Middle East Gulf countries blush that we will cut output, where do you raise cash? You have to sell.
Okay.
And there are media reports about obscure trading companies that have sprung up in the last 12 months or so, which are buying crude from Russia and supplying in European and Asian countries to skirt sanctions. This will continue.
All right. So, Vijay, to cut it short, what is the impact we are going to see for India? Are we seeing crude inflation going up? Are we looking at spending more money to get the same amount of crude as opposed to what we were spending about a year ago? What sort of impact are we looking at on our current account deficit at this point?
I don't think our crude import bill is likely to go up unless a black swan event comes, an outlier event comes. Say China attacks Taiwan or something else like that happens. You must remember that there is one thing about rack rates in crude prices, and the other thing, backdoor discounts that the Saudis, the Russians, the Iraqis, the Iranians give. So you could say that I'm not going to sell below 80, but you're saying that in front of the media. But you could whisper to your buyers, hey, when you come to me, I will sell it to you at 5% less. Look at how the Saudis have assured Asian and the North American markets that we are going to supply all the crude that you need in spite of our output cuts, and all the discounts will continue. So I don't think our crude bill is going to go up. No worries there.
All right. So that is, of course, an interesting, important point of view. Crude bill not likely to go up. This may not have any impact, of course, on India, even as Russia continues to increase interest rates. Remember, the trade between India and Russia, in fact, Krishna Kumar, who joins us here in the studio, is at an all-time high, and there has been a threefold increase in import of crude oil from Russia in the first quarter of this financial year. Vijay, thanks very much for taking time out this afternoon. We will come back to you for more on that story, but let's move on. Inflation is hitting through the roof. Retail inflation rate surged to 15-month high at 7.44% in July of 2023, primarily driven by rise in prices of vegetables, cereals, pulses, spices, milk and other eatable products. This, of course, as per data released by National Statistical Office (NSO). The inflation print had last breached the 7% mark in September of 2022, and the previous high for the headline inflation rate was recorded at 7.79% in April of 2022. This is the third instance of retail inflation rate crossing the upper limit, which is 4 plus minus 2%, banned for the Reserve Bank of India's medium-term inflation target for this calendar year. Let's talk about the impact that this inflation, or very high inflation rate, is going to have on people, and what can the government do. To talk about that, joining us on the show is Yuvika Singhal, who's an economist with Quantico. Yuvika, thanks very much for taking time out. Good to have you back once again on the show. I want to first begin by understanding from you, how worrying is this? An inflation print of 7.44%, how worried should we be?
Hi. So yes, it's somewhat concerning because it's an elevated inflation print, like you rightly pointed out, above RBI's comfort level or the inflation targeting band of 6%. And it surprised the number that we saw, coming on Friday. It surprised most of the market expectations, somewhat on the upside. So we were pegged somewhere close to about 6.9, and the number did surprise us a good 50-60 basis points above that. So yes, it's somewhat concerning, but I think if we deep dive and take a look, there are some concerning and not so concerning aspects in the inflation fine print. The most concerning, probably, which has caught a lot of attention, is the inflation that we've seen driven by tomato prices. And we have seen prices skyrocket through the months of June, July, and even continue to remain elevated in August. So a large part of the inflation has been driven by tomatoes. Not just tomatoes, but a bunch of other vegetables also: ginger, garlic, chilies, some bit of price pressures beginning to inch up in onion prices as well. But if I was to look at a broader commodity of the food basket, we do see price pressures coming in from some of the other staples that are consumed by the households, especially those on cereals, both wheat and rice. Some bit of price pressures also coming into other subcategories such as spices, pulses. So overall, we do find that momentum in food was somewhat strong, not just because of vegetables and within which tomatoes, but also some broad-based price pressures in other categories such as cereals and pulses. So that is one part which is definitely concerning. I think there are two things to keep in mind: that typically tomato prices are extremely seasonal. So we've seen in the past that months of June, July, we typically see tomato prices shoot up. While having said so, this year's price escalation is much beyond anything that we have seen by historical standards. But notwithstanding that, we also expect a seasonal correction in tomato prices to follow. And that is when the new Kharif harvest of the tomatoes coming into the market somewhere around August and or early September, we should see a pretty sharp correction in tomato prices and some of the other vegetable prices. Now, what will be interesting to see is that once that seasonal correction pans out, whether it's in line with expectations, and do the prices normalize completely by end of September. So that is one thing that we'll keep a watch on. And second, whether the other price pressures that we are seeing in cereals, pulses, and we know that the government in the last few weeks has been extremely proactive in taking a lot of administrative measures to rein in price pressures in some of these other food categories. So we'll have a better picture emerge when some of these administrative measures have had their full role to curb the price pressures. So we will know where we stand as far as food inflation is concerned, and by that time we'll also have the end of the southwest monsoon pretty much known to us. We know that monsoon performance has dipped in line with expectation with IMD. We are looking at a 5% deficit vis-a-vis long period average at this point in time. So a clearer picture would emerge. But having said so, just the rise and the pace of increase that we've seen in prices in the months of June and July have meant that our entire year's FY24's inflation forecast is now looking revised upwards, and we have, in fact, before the data release, we upped our entire full year CPI inflation forecast from 5.3 to 5.5, and we continue to see some upside pressure coming onto this number further, could be to the tune of 20 basis points, depending upon how global prices perform, whether like I said, the domestic prices normalize or not, and the monsoon performance, which will be critical in the months of August and September to determine how the crop yields are by the time we close the Kharif season. So this is broadly what we are thinking. Just to add one more point.
Sure.
I think the only comfort that we drive in this CPI print, which did seem concerning, like I said, on food, tomatoes, a lot of other subcategories, is the correction that we continue to see in the core side of inflation, which we call the demand side of inflation, which continue to remain fairly elevated above 6% for a very long period of time. And now we see that month after month, a correction on the headline core inflation print, which now, in fact, for the month of July, dipped below 5% for the first time in almost close to about 2 years.
All right. I want to take this one after the other, and Krishna is also here with us. We discussed this story in the morning. I think one of the things and crucial takeaway for us from this conversation is a lot of these things are not in our control, is not in government's control. There is supply side problem, there's the southwest monsoon, there's the excessive rainfall or deficiency of rainfall, a lot of which we cannot control. There have been some administrative measures, as Yuvika also pointed out, that the government has taken at this point in time. But a lot of it, Yuvika, is not in government's control. We want to understand what exactly is in government's control. What more measures can the government take apart from, we saw in case of tomato prices, government tried procuring tomato from western part of the country to supply it to the northern part of the country where the prices were at an all-time high. But what other administrative measures do you think that the government can take at this point in time to control inflation?
Right, so I think the easiest to do is something on the cereals front, where both rice and wheat have, we typically have the buffer stocks available in the country, and this is something which has been done since time immemorial, that government goes out and procures rice and wheat after every Rabi and Kharif season respectively to build on the buffer. So the easiest would be to have open market sales, put out more rice and wheat into the market. And cereals, to remind you, contributes almost 10% of the food basket. So that will have a sizable impact. And it's not just rice and wheat, but derivatives of rice and wheat. Both are used extensively in other products, bakery products, confectionery, etc. So the multiplier effect of cooling of rice and wheat prices moves beyond just the staples, but a derivative of products which use them as raw materials. The other thing where the government has been active and could be perhaps a little bit more proactive on the pulses front, we have seen imports of pulses one-to-one between different governments, Indian government and some of the other pulses producing nations getting delivered. We also hear of the possibility of wheat imports, which is not a bad idea per se. And we could also see some kind of tax reduction on those wheat imports to make it a bit more lucrative as far as price points are concerned. I think these two, pulses and cereals, being a large dominant by weight in the CPI basket, if the administrative measures are will be much more useful on these fronts. And like I said, on tomatoes or vegetable prices, usually the crop cycle is extremely small, anywhere between 2 to 4 months. So there the seasonality will kick in. It's just a matter of probably a few weeks from now. We already see tomato prices on a daily basis move beyond the peak. So in the last few days, we have seen tomato prices correct. Still a long way to go to achieve the pre-June levels. But nevertheless, I think the peak is past us. So the point that I'm trying to make is that the administrative measures need to be on more on the cereals and the food grains front, where the negative surprise could be seen as far as the Kharif rice is concerned, or our wheat buffer stocks are lower. That is where the action needs to be, and the horticulture and the vegetable oriented prices would anyways give you a seasonal respite by the time we are in the month of September. So I think that's where the balancing act needs to be, that the focus has to be on cereals and pulses.
All right. And you mentioned imports. Would you also be of the suggestion at this point in time that we limit exports? We've done so in case of rice. That sort of helped the rice prices cool down in India. Would you suggest the same for other pulses and other cereals too, to perhaps bring in some sort of export restrictions?
So for pulses, not as much, because India is a importer as far as pulses is concerned. So we continuously happen to rely on imports year after year. So there's nothing much that they can do there. As far as rice exports is also concerned, we are sitting on somewhat comfortable buffer stocks. In my mind, the measure of exporting, a complete blanket ban on non-basmati rice exports was somewhat, very, I would say, very preemptive in some sense. They could have waited and seen how price pressures actually pan out over the course of the next few months. But I think that's a decision that the government has taken. But we are still on comfortable buffer stocks as far as rice is concerned. And not to forget, we also being a major rice exporter, India has the the ability to stoke rice inflation globally. And given that this is an El Nino year, which could impact adversely a number of the rainfall performance in a number of Asian nations, which are rice producers, maybe a couple of months down the line, we'll see global prices of rice actually moving up much more strongly than we have right now. So there are a lot of, pulls and pressures as far as limiting exports or imports are concerned. And I think it's something very dynamic, because the global dynamics are also changing given climate risks and the evolution of climate that we are seeing, especially with El Nino knocking at our doors. But I think the government has to be, the moot point is that the government has to be nimble-footed to take action to not just rein in price pressures, but also keep in mind that we do not stoke global inflation pressures, because that could also come to haunt us at a point later in the year.
All right, and before I let you go, I know you have to run off to a meeting, but addressing the elephant in the room, these numbers are dampener. They are also going to be closely watched by the RBI. What are you expecting as far as the next MPC is concerned? Or is it too early to say?
No, so I think the jury is out there that, as far as RBI is concerned, and a number of, close to about 7.4 is definitely raises red flag, as we called it. It's a red hot inflation print. I think what needs to be seen here is that a large part of it is, like I said, driven by supply side shocks, especially coming in from vegetable and tomato prices. So we know a large part of this will get reversed by the time we are in the month of September. What RBI also indicated that they are willing to look through these supply shocks as long as these supply shocks are only temporary in nature. But if there was to be a durability in the price pressures, not just of vegetables, but also of other food prices, because they could stoke generalized inflation, impact inflation expectations of households, RBI will be on careful watch. So as of now, while our base case scenario obviously remains of a prolonged pause, the timeline to cut probably has gotten shifted another quarter. So even earlier, we were not looking at any rate cut in this fiscal year. We were calling for a quarter one, but probably the wait to a cut has gotten prolonged by another quarter. So probably quarter two of FY25 is what we are looking at for rate cuts. And if you ask me for a rate hike, it's an outside chance. Like I said, there are too many moving parts at this point in time, but we'll have to wait and see whether the durability of the inflation price pressures that I talked about move beyond the months of October, November. At this point in time, we are not looking at a rate hike, but an outside chance, I think, cannot be ruled out either.
All right, so you can never say, you can never predict. This is a difficult, of course, number to digest, and as you can see on your screens, food inflation indigestible at the moment. Krishna, nice wordplay at that. Yuvika, thanks very much for joining us. We're hoping to get you back very, very soon. I hope you can spare some time for us once again, but we're going to move on for now. Foxconn, the iPhone 14, biggest, in fact, one of the Apple's biggest player in India, is hoping to make iPhone 15, not 14, in India, is going to enter production phase in Tamil Nadu at the Foxconn plant here. The move is aimed at rapidly ramping up the quantity of new iPhones that are manufactured in India. So you are in fact looking at iPhone 15 made in India very, very soon. Now this is of course the company's effort or a plan to reduce the disparity between its manufacturing operations in India and its primary production hub, which continues to be China. Not just that, Apple will also start manufacturing its wireless earbuds, AirPods at Foxconn's Hyderabad factory or facility, according to various newspaper reports. Now, Foxconn has approved an investment of $400 million for Hyderabad plant, which is expected to begin mass production by December of 2024. Krishna, we're not only looking at an iPhone 15 made in India, we're also looking at AirPods made in India. Good news there, win-win for India.
Well, absolutely. The only clarity at this stage, just to be the devil's advocate, is that I don't know if, again, these are made in India as in assembled in India or going to be made in India. Because let's face it, as far as the iPhone 15 is concerned, the semiconductor chips are not going to be made in India. Most likely they are going to be imported. I just want a clarity at this stage of how much it is. But the fact of the matter is that a brand new iPhone that will be launched, say in a month's time from now, we already know that it will be, a good chunk of it will be manufactured out of India. Okay. And that in a sense sort of signals a very definitive shift towards the direction in which things are going. It's a matter of how many, what is that percentage of iPhone 15 that is manufactured out of India? We don't know that. If there are 100 iPhones 15s that are manufactured, how many of them come from the India plant? And similarly with the AirPods as well. Hyderabad factory, yes, you have data that just is telling you the facts of the matter. $400 million being invested into the Hyderabad plant, Foxconn plant. So clearly they're expanding capacity. And if they're expanding capacity in AirPods, it's a win-win in the sense that, you have more of the Apple product portfolio getting made out of India, from iPhones to AirPods. We already have enough going out in the form of assembled phones and assembled tablets and assembled other things. But my curiosity at this stage, Shweta, would be to understand how much of the actual manufacturing, say, do the panels of these iPhone 15s, are they made in India? Are they going to be made in India? Are they going to come from Tata Steel, these aluminum panels, like that. So my curiosity at this stage would be to understand further as to how much of these iPhone 15s and how much of these AirPods are manufactured straight out of India.
All right, that of course is an intricate detail that we'll have to figure out. But at this point in time, we do know that Apple supplies, which is Pegatron and Winston. Winston is soon going to be acquired by Tata Group. So I don't know if it's too much of a speculation to suggest that perhaps Tata Steel could be looking at making casings for iPhone in India. But all of that in the realm of conjecture at the moment, because now there's not much clarity that has come in. So I think it would be crucial to wait and watch out for whether assembling will happen or manufacturing will happen. But manufacturing to some extent, if not all.
That's what it is at this stage. It is to some extent. The question is how much is that extent. At this stage, it is unlikely to expect literally every single thing inside the iPhone, every single thing inside the AirPod to be made out of India. The only hope is that a huge percentage of it gets made out of India. Wistron being acquired by Tata Group, Wistron facility being acquired by Tata Group is the reason why I even mentioned the fact that I mentioned the possibility that maybe the iPhone's panels could come out of the Tata stable. But then again, these are in the realm of speculation, as you're rightly pointing out. We're talking about it. We're hoping that's the case. So at this stage, I'm going to be on a wait and watch mode before I celebrate too much, Shweta, because so much of made in India is still only purely assembled in India. Whereas I'm bullish in the fact that the more and more made in India products come out, you're helping that cause and labeling it right. I think there should be two different labels at this stage. Call some of them just assembled in India, just AI, assembled in India.
If that's a word that you can print,
you can use all made in India,
but made in India for sure. And this is interesting because iPhone 15 is slated to be launched in September, if that's the correct timeline.
About a month away from it.
Month away from it, which essentially means there's not enough time, of course, to start producing all parts. If it has started now, what we do know for a fact, the assembling must have started now, different parts being brought in from different parts of the world. But interesting to point out that Apple had in fact pledged last year to bring in 45 to 50% of its assembling to India as a move away from China. So India, they're benefiting on the China Plus One strategy, and Foxconn is one of those players that you cannot either neglect or sideline, because it's making literally everything. It's entering into the semiconductor space, it's entering into the four-wheeler space, EV space, hoping to build an entire ecosystem and not just assemble in India. So I think when you talk about the overall plans that are afoot, especially from Foxconn, that at least brings some cheers.
No, definitely. I mean, even assemble in India is fantastic. And I think that's phase one, like the way Apple is doing it. Apple is, first of all, now wants to assemble half of its production in India. And that means that eventually it would want to move half of its production to India, which is a little unlikely at this stage. So I think it's phase one. It's a step 1-2 punch. First, you bring all the assembly over here, get the systems going, get the plants and facilities going, and then you bring in actual manufacturing. So I'm hoping that there is that payoff, and that's everybody's hope that India sort of enters manufacturing, electronics manufacturing in a big way. Because yes, there is move out of China, but India should not be overconfident that all of it is going to come to India, especially electronics manufacturing, because of Vietnam, Czech Republic, other economies which Taiwan, which are already in that space.
Far ahead.
So far ahead. So, and also it's going to be China +1. That's the future. It's never without China. So can India be the +1, and how much of the +1 can India be? That's the future. So
all right. So China +1 for now. We don't know who that +1 is, but India, of course, planning to milk that opportunity as much as it can at this point. Krishna, thanks very much for joining. We're going to move on now to a story that we're tracking by the way of a special documentary we've made here on News9. From the ancient terracotta figurines of the Indus Valley civilization to the intricate wooden creations of Chanapatna, each region has sculpted its unique chapter in the timeless art form of toy making. However, despite its deep-rooted history in toy making, India surprisingly remains relatively unnoticed as a toy making nation on the global stage. In the grand theatre, $100 billion global toy trade, India's presence remains diminutive. According to various figures out there, it's a mere 0.5%. In contrast, our neighboring juggernaut China commands a substantial 59% market share. However, in just 4 years, India has achieved a remarkable feat, boosting toy exports by a staggering 172%, while curbing toy imports by an impressive 75%. This led India to become a net toy exporter for the first time in financial year 21, a monumental achievement. My colleague has in fact documented, Suyash, I'd request you to come join us, has documented the journey of India's toy transformation. Before we watch that documentary, I want to begin by understanding, how did we achieve here? We have a very insignificant share of the global export trade in toy manufacturing, 0.5%. China is at 50%. But we have finally become a net exporter. This according to, of course, your own calculations. You've spoken to a lot of players. Run us through the journey of this transformation.
So Shweta, India's toy story is actually very interesting. So before, like a decade ago, what India's toy industry was primarily, the state of the industry was, it was highly fragmented. So most of the big manufacturing units belong to the MSME sector. Now, in the last 4 years, we have seen a very sharp spike in exports. About 172% exports has increased from FY19 to FY23. Now, we also need to take this figure with a pinch of salt, because India's share itself was at just 0.5%. It currently stands at 0.5%. Now, was it because of the world wanted to move out of China? The entire dialogue about or debate about the China +1 strategy. So is it because of the lower base effect that we saw such a sharp spike in exports? And at the same time, when we are talking about 75% reduction in imports, government has hiked import duty on toys from about 20% in 2020 to about 70% as of budget 2023. So is it a result of protectionism, or India's toy industry is like fundamentally gaining strength? So that is something that we were trying to look into this documentary. Another point that we were
were you able to arrive at a conclusion?
I would want you to see the documentary and find out the answer for that.
Okay.
Another thing that we wanted to touch upon in this documentary was how India figures in that China plus one debate.
Okay.
You know, what advantages does India have compared to other emerging markets like Indonesia or Vietnam, and also what stops India from delivering a brand which is, you know, of a size of a Mattel or Lego. Now, of course, to, you know, build a brand, it requires a lot of investments, and as we have seen, India's purchasing power compared to developed markets is significantly lower. Now, if you look at the numbers, an average toy in India costs about $200 to $250,
Okay.
which is less than about what, $3. In US, average toy costs about $50 to $60,
All right.
which is what, 4 to 5 grand. So there is a big discrepancy there. The middle class is definitely growing, and India is finding its place in this entire toy economy, so to say. But, you know, there are a lot of questions that need to be answered.
And I think you've tried answering those questions. Let's quickly play in that documentary. We'll leave you with that.
ग्लोबल टॉय इंडस्ट्री 7 लाख करोड़ रुपए से भी अधिक की है। 7 लाख करोड़ रुपयों का इतना बड़ा कारोबार, लेकिन भारत का हिस्सा उसमें बहुत कम है।
...2023 has been a unique year where we've seen two global blockbuster hits. One being Barbie the movie and the other being Super Mario Brothers. Both films, incidentally, collected $1 billion plus each at the box office, and both films created on iconic toy characters that became so popular the world over that it had movies made on them. Now the point is, India, despite being a large middle class, despite being one of the fastest growing economies in the world, has so far in its history not been able to create even a single toy brand that could compete with the likes of Barbie, Mario, Lego, Hot Wheels, and all the other famous popular brands that we see in the world.
It is not fair to compare Indian brands with Lego and Mattel, because they've been around for a very long time. They've built their market in mature and developed markets of the world.
So Mattel had a Barbie, Lego had a Lego block. So around that the company is built. India still is at a nascent stage in innovation.
As a vision, it's great, but when it comes down to executing it, there have definitely been challenges, in India. I think the first one was more about, being able to create truly world-class products.
Till the late 1990s or even early 2000s, toys was a restricted area. That means large factories could not be set up. This was reserved for the MSMEs.
The biggest hindrance to the progress of the industry is affordability. The challenge is to make toys affordable.
There is no specific toy design school in India. There is only one course that is done in postgraduate in NID. We want more design courses for toys, which is going to bring in more people who will innovate and create new products.
So while innovation is something which is obviously lacking, the problem really is that India has found a very sweet spot in developing a contract manufacturing base for global toy brands. But in this whole new era of the post-COVID China plus one philosophy, India is not the obvious plus one. There is enough and more competition from other emerging markets as well.
The supply chain disruption brought to notice to the global world about its dependence on China. And obviously people want to expand out of China, have other options. So Vietnam, Indonesia, India, Thailand, every country saw its exports grow.
many overseas companies are sourcing products from India. I mean, lot of companies clearly want to move away from China and start procuring at higher levels from India.
The kind of investment that India is willing to attract is far superior to a Mexico or a Vietnam, right? Because those economies don't have the long-term potential an Indian market has.
Earlier, Indian exports were limited to African countries and to some areas in the Middle East and to APAC. But now we are exporting a lot to USA, to UK, Europe, Canada, South America.
So even though exports have grown, we don't still have a large chunk of the overall toy manufacturing base here in India. But the focus has to now shift to quality. And that is where India will need to see a lot more investments by domestic as well as global players into creation of quality hubs where great quality world-class toys can be manufactured, can be produced for the domestic market and for the export market. Now, the government on its part has been a little liberal when it comes to crafting these policies to give a fillip to the toy sector. One of them, of course, is inclusion of toys as an industry in the National Action Plan 2020. In addition to that, there are these toy clusters or special economic zones which are coming up, and FDI has been relaxed to as much as 100% of FDI can inflow into the toy sector. But investments will have to be made into ensuring that India is able to produce the best quality toys and not just create toys which are cheaper than China.
The Government of India, after the clarion call by Honorable PM, they started looking into this industry as a prospective champion sector, and they were happy to include toys as one of the 24 categories in the champion sector. It is the only sector in India where there is a national action plan. So 14 ministries, 2 other departments of government, they are working day in and day out to come out with a strategy wherein toys can be a global champion sector also. For the financial year ending on 2022, we had exported to 113 countries.
Now what you're seeing is, in the past 5 years, the growth of the contract manufacturers which have invested in a very large scale and set up very modern facilities which would be at par with anything that you see worldwide.
There are so many international companies who now source products from us, from Fun School and from others in India. And that business is also really taking up, which proves that India have the capability to make world-class products.
Import duties on toys have increased from 20% to 70% as announced in Budget 2023, which means Indian parents who want to buy toys of global brands for their children, for example, Barbie, Lego, Fisher-Price, etc., will have to now shell out about 70% more. That's almost twice of what it would have cost them otherwise. And this in the absence of an equally compelling substitute product in way of Indian brands, because Indian brands of that quality don't exist in the Indian market. The toy makers in India are obviously very happy with such a protectionist regime because they find a very lucrative market where they're able to sell at a much cheaper price. But what they're selling at a cheaper price is also cheaper quality.
So India was an import surplus country, and that too by at least 10 times. I'm very proud to tell you, in FY22 and FY23, we were export surplus in both the years.
Now we have what I can call, a situation where it is advantageous for Indian manufacturers with higher customs duties. Some kind of protection has happened because we needed that very badly. And this should continue. That is the main thing. If tomorrow the floodgates are open and all imports start coming in from China and at ridiculously low prices, it's always a mystery how China is able to sell products at such low prices. So if that happens, things could change. But otherwise, if there is consistency, I think that is the most important thing. And Indian companies will continue to do higher volumes and get better.
Now, protectionism, I feel, is not the best option for a real industry to flourish in a competitive manner. What toy makers have to take onus of is the fact that they are able to produce the best class toys which compete with the best in the world. And these toys, of course, both for the domestic Indian market as well as for the export market. On this part, I feel what the government needs to do is open up the PLI. It's been pending for a while. Open up PLI, attract the best global brands to come make here in India. There is no import duty then. And therefore, they are going to compete at a level playing field with Indian toy makers. And this way, Indian toy makers, obviously given the competition, is going to shore up its own game. Right now, Indian toy makers continue to bask in the glory of their top line swelling up on the basis of the protectionism offered by the government.
Has India's share in exports increased in this industry? Yes. Have manufacturers in this industry grown their business? Yes. Is more capacity coming up? Yes. Is more brands and retailers globally making in India? Yes. Are more startups emerging in this space? Are they able to attract capital? Are they able to build sizable businesses? Yes. So everything is moving in the right direction.
All this will happen. It's only a matter of time. We are in early days, the Indian toy industry, and I think good times ahead. Certainly very good times ahead.